Hello, everyone. Today on the final bar, we're going to wrap the week. Every Friday, we like to take a step back, look at how the markets have evolved Friday to Friday. Obviously, uncertainty has been the story, but it accelerated in the last 24 hours with news of the president and COVID-19. The market came off overnight, started at a lower level, but overall has been sort of in the middle with small caps and mid caps actually doing pretty well today. We'll look at all of that and more. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at the markets through the charts, try to bring the markets to life by looking at data visualization and really the story of technical analysis, the story of visualizing investor psychology, trying to get inside the head of other investors, identifying trends, following those trends, and anticipating potential trend reversals. And uncertainty is a word I feel like I've used a lot in the last couple months, if not even more than that. Especially as the market pushed to new highs, the question was a lot about, is that sustainable? How could we expect further upside? Is there potential for downside? And all these headwinds and tailwinds that we keep trying to digest. And just when you think we don't have enough things to try and figure out, news like we've seen in the last 24 hours, again, it's just an unknown. I saw some people posting, trying to post similar scenarios of where you had a president who had a health risk and what that did. But, again, there's just nothing like this exact environment. So, for me, what do you do in that sort of situation? I always go back to the basics of following trend: uncertainty, confusion, desperation, euphoria, optimism, pessimism. All of that is and should be reflected in the price. So the best toolkit you have is not reading a bunch of newspapers, is not following a bunch of commentary necessarily on macro themes. It's looking at the charts and making sure you're aware of what's happening out there, what's working and what isn't. Now, we have some great guests to help us navigate these markets this week. Again, we had just a fantastic three guests that joined us. Next week, more of the same. So on Tuesday the 6th, we have Jay Hatfield from Infrastructure Capital Management for the first time joining us. On Wednesday the 7th, Willie Delwich from Robert W. Baird. He's their global strategist. And then on Thursday the 8th, JC Peretz from All Star Charts sharing some charts of interest with us. So some wonderful guests, and to be honest with you, you've had a number of discussions this week on the StockCharts TV team, not just for the final bar, but for the rest of the StockCharts TV programming through year end. There's some wonderful special events and specials to throw your way, and we're excited to get them worked up and present them to you very soon. The goal of every Friday show is to wrap the week, and that's where we take a step back to the 30,000-foot view of what has changed from Friday to Friday. Before we get there, I did want to start with a poll question. We asked you recently, where does spot gold close on December 30th, 2020? So essentially year end, where is gold and where does it close? As a frame of reference, right now I'm looking at the gold index. We're right around 1916, 1915 as of yesterday's close. So 37% of you, the most popular answer was between 1800 and 2000, which is essentially where we're at. This is the range that we've been in really for the last 3 months. Gold had that big rise into the peak in early August, peaked about a month before stocks did, and since then it's been in a stopwise move, and so far gold has found support around 1850. So over a third of you saying we remain in that range. 31% say over 2,000 to 2,200, which would be retesting or even pushing above previous highs. And 19% of you said above 2,200. So what's interesting to me is almost exactly half, 50% of you said basically above 2,000, which means we break above, looking at the chart, break above that swing high from August and September. The gold topped out just below 2,100, came down to the upper 1,800s, rallied back just above 2,000, and basically over half of you are saying we're in this range, which is materially higher from here. I didn't answer this question, and I should note, 14% of you said below 1800, which would be that's a pretty big move. Although it's not that far away from here, assuming that would be year end below there would be pretty severe and put us back to the levels from spring of this year. If I had to answer, I would probably say 2000 to 2200. I wouldn't be surprised if we fluctuate a lot in these general areas before we appreciate, over the next 3 months in some way. But interesting to hear some optimism on gold. Hopefully you've been paying attention. We've been talking about the long-term setup in gold, which overall is still, I think, one of the more constructive long-term charts. If you look from bottom left to upper right over the last couple of years, it's been a decent uptrend for sure. In terms of what's happened, we'll talk a little bit about today's trading. I just want to focus on sort of the weekly change. I'm going to refresh this chart just to lock in today's closes. Sorry, the labels are a little off given some adjustments, but overall, here's where we're at. The S&P finishing the week around 1.5% higher, 1.6% really. The NASDAQ with today's pullback essentially was one of the top performers, came down below and was up only 1% over the period. Things that outperformed stocks this week: gold was up 2%, emerging markets were up almost 2.5%. The big winner this week, though, was small caps, up 4.4%. And again, the biggest, most impressive gain, if you look, pretty much everything was down today except for the dollar and small caps, both of which found a way to chip higher. So there might be a signal there for sure. In terms of what underperformed the S&P, we mentioned the NASDAQ up only 1%. The dollar was down 0.7% in the form of the UUP, the dollar ETF. Bonds in the form of the TLT down 1.3%. Bitcoin down 1.6%. Crude oil, really the big loser, down 7%. Let's look very quickly at just how things played out here on Friday. As I mentioned, obviously we're here on the West Coast, and so the news of the president coronavirus positive signal came in the evening for us. It was about 10 p.m. I want to say when I saw it, and so I ended up staying up for a while looking at long-term charts, thinking of ramifications. And my poor friends on the East Coast, I saw them still up tweeting about it and everything. So I'm sure we're all feeling the pain of lack of sleep right about now, given when all of this came out. But, the futures dropped pretty quickly, which is understandable. When there's uncertainty, that's usually the reaction. But since then, that was pretty much the low. We opened at the lows of the day, retested those, and around lunchtime, it felt like this could be a big push lower, but it recovered pretty well. The last 30 minutes came off a bit, but overall, stocks held up much better than they could have. We could have digested that news in a much more negative way. The S&P just finished down 1% today. I think the big story, though, small cap and mid cap finished really essentially toward the highs of the day. The NASDAQ really drove things lower. So a bit of a change of character from what we've normally seen. If you look at the sector rotation, real estate and utilities, number one and number two, those are both up on an absolute basis, 1 to 1.6%. In terms of what did not work, it's the flip side of what we saw yesterday, tech and communication services at the bottom of the list. So, at a time when it felt like tech is regaining its footing, and all of a sudden it's the return of the mega cap tech trade, sort of what we've been used to for a while. I think, a day like today with the news that we saw and the reaction, this tells you how technology, communication services, even healthcare, how they can react to some negative news or certainly an increase in uncertainty. Just very quickly, bonds finished a little bit lower. The dollar a little bit stronger today, as I mentioned. Gold and silver were essentially flat going into the close today, essentially chopped around the midpoint. Let's get to our Mindful Investor Live chart list, and really the purpose of a weekly chart routine. And as we've talked about many times, I find routines are incredibly important. As I've hopefully, as you've heard me say, I think a consistent, imperfect routine is light years better than a perfect but inconsistent routine. It doesn't matter if you have the best charts ever. If you don't use them in a consistent and repeatable way, you're really not, you're not serving yourself well in terms of your ability to synthesize what you see in the charts and apply them in a consistent way to help you perform better. So this is part of my weekly routine, which essentially starts on Thursday and ends on Monday. And it starts with a look at macro charts like this and starting top to bottom. Let's see how many we can get through during this Wrap the Week segment. So number one starts with our weekly market trend model. Our long-term market trend model has three components, and we've gone through this before. If you're not familiar with this, go through some of our previous Friday shows. I'll talk in a little more detail. The long-term trend has been positive since June, remains in place because the 21 and 34-week moving average exponential averages are still in a positive configuration. The really interesting stuff is down here at the bottom. So the medium-term trend for the last 2 weeks has been really close to switching below the zero line. And if we'd seen more of a sell-off, I started to think today might be the day where, the week where you actually get a negative signal. We didn't get it though, and the market had rallied enough before today to to keep these this trend positive. And this is based on the traditional weekly MACD or weekly PPO model. And when we get across down there, that would be a sell signal. Last sell signal we got was in mid-February, just as we had that first big leg down. And so that's certainly something I'm looking at as I'm thinking about the potential for further downside from where we're at now. This short-term trend is just looking at the price relative to the 5-week exponential moving average, just barely closed above it. It looked like it did, so I switched this positive, but it's essentially right flat at the zero level, given where we closed today. The daily chart, we've been talking about this movement between 3,200 and 3,400. And one of our questions is going to get in a little more detail on this idea, but this is sort of the framework that I see us at. I usually think of price levels, support and resistance levels on the daily chart in terms of lines in the sand, right? You'd expect support at a certain level. If we break it, that tells you the momentum is enough to push us to the next level, and the same on the upside. So right here, if we were able to close above 3,400, follow through to the upside, which would take us above those swing highs, that first reaction off of the pullback in early September, I think that would clear the way to 3,600, if not more. And it would not be surprised for us to get that at some point. This, the way this week played out is we basically have come off of that support level, which we identified from back here. We've now tested the resistance level we've identified from back here. We're back below the 50-day moving average, so we did not get the follow through that we would have wanted today. If you're optimistic for further upside, I think we're still very much established in that range. So I think at this point it's still a binary outcome. We break above 3,400 or below 3,200, and that's the trend to watch. Given what I'm seeing across the board with breadth characteristics and overall potential weakness, my base case is that we go below 3,200 and we find support further down. But again, I will not clear the way for that signal until we break down through the new lows. But at this point, lower highs and lower lows are the tactical time frame. Continuing on, this next chart is one we refer to pretty often. This is one of the main ways I'll look at breadth. We have a couple reads that we'll make on it, but essentially it's the cumulative advanced decline lines for some of these different cap tiers, and they're color-coded red. One is in orange here, the S&P one, which is essentially flat here recently, but the rest of these certainly more negative with lower highs and lower lows. Potentially, I think this would change more neutral if we were able to break above that swing high from earlier in September. This is not updated for today's close, and this will most likely come off a little bit. So I still don't think that will happen now. I think going into next week, we'll have continued downtrends on each of these advanced decline lines. And again, overall, I would be much more comfortable being bullish on the market if these lines are sloping upwards, because that tells you that stocks are managing to close higher than they were the previous day and have build up that trend over time. We're not seeing it right now. We talked about this, and I feel like this is one of our 3 and 3 charts recently, which is basically looking at the new highs list. If you look at the new highs now versus the new highs in mid-July, I think that's the difference, or what you would be looking for. If you are expecting this sort of tactical pullback before the next leg higher and we're moving up to retest highs, you would want to see an increase in the new highs list. And at the most, this got to about 10% of the S&P on a given day, making a new 52-week high. We're nowhere near that. We're still in a handful of stocks on a good day. So we haven't seen enough stocks like home builders come to mind that are already up here, are breaking to new highs. Most stocks are not doing that. You need to see some of those early adopters kind of breaking to new highs to feel good about further upside. Now, one thing to pay attention to, this is looking at the percent of the S&P above their 200-day moving average. It's still just above 60%. And again, not quite updated for today yet, but that's where it has been. We are right at the 50% level of stocks at their 50-day moving average, or above their 50-day moving average. So the S&P is sort of flipping back and forth of its 50-day, and you can see that many S&P members are doing the exact same thing, fluctuating above and below. You'd want to see these remain above 50%, which tells you more stocks than not are able to reclaim that 50-day moving average. I would expect that to come off today as stocks sort of came down a bit. We talked about sentiment in a little detail yesterday in terms of AAII and elsewhere, but overall, this sentiment read from individual investors has certainly remained negative. It's been a very unloved rally according to this survey relative to previous periods. And again, for what it's worth, I think you would want to see, sort of bouncing off of these extreme low levels and starting to see optimism at some point. The fact that we broke to new highs and never really got a decent upswing in bulls versus bears tells you how little at least that cohort of investors have been supportive of the recent uptrend. Some ratios to look at very quickly here to wrap up. And first, I would just look at consumer discretionary versus staples. This is a line we've talked about for a little bit. It potentially is building up for a little bit of a base breakout here, which would tell you that this is consumer discretionary versus technology here at the bottom in brown. It's very close to actually breaking to a new swing high, which would tell you finally technology is underperforming consumer discretionary, one of those big themes that has not necessarily been the case. They've essentially been lockstep for quite a while. The world is not as supremely negative as I think it looked as things were coming off of the September high, because certain things have been alleviated. One thing that has remained relatively positive is the relative performance of semiconductors, and we'll stop it here. I think that's one chart to certainly continue to follow. In general, when that group does well, it's a bellwether group. If that group's doing well, it's hard to think that things could get that bad, because no, this is a central part of how most of us are living our lives right now. So strength in semiconductors continuing through the end of this week. We need to take a quick break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey there, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Love hearing from you and love answering your questions on the air. We're going to get to our mailbag segment here in a moment. I did want to remind you ways to get questions in front of us. Best way is via email, thefinalbar@StockCharts.com. We hear from many of you regularly, and we really appreciate your questions, your feedback, and things that we can address on the air for you. Also on Twitter @FinalBarSCTV. Or on our YouTube channel, just put a comment below any of our videos. And these are questions we've received really in the last day or two from many of you. Let's get right to it. First question, any favorite scans that you use regularly that can help us find potential ideas? So, the scanning engine is one of those we talk about randomly, and you'll see me use it. I don't get into a lot of detail only because I know it takes a lot of time to really do it justice and help, be more instructive on how to use this. So we don't have enough time to really go through the details. As always, I would encourage you to look on our YouTube channel for videos from Chip Anderson. There's a show, Deep Dive, with Chip Anderson. He's done some shows on the scanning engine that are really, really well done. He obviously was pretty key in designing it, and so knows it better than anyone. I'm going to share with you just a couple of them that might be good starts. From there, you're welcome to do it. The one that I use the most out of all of them is this one, which is S&P 13-week highs. And the scanning engine is text-based, so it's sort of a very simplistic language to describe what you want to do. And if you've never used the workbench, it's all driven by these drop-down menus. So you pick something that are all in here. There's predefined scans, which is a really good place to start if you don't know what you're doing, because if you pick one of them and click on add, it'll put the argument right up on top, and you can run the scan right from there. So the first step is sort of define your universe. I usually set mine to the S&P 500, but I would encourage you to explore other groups of names, of course. I just use this so we have some good examples to look through. And then here I'm just basically saying, this is taking off of the predefined scan. If you say new 52-week high, and I just tweaked it for 65 days. So it's saying today's close is greater than yesterday's daily max close for the last 65 price bar, 65 days. So that's a scan that I do. And again, I would never look at that group of stocks and think, okay, that's my watch list or something. It's a list that I start to go through. So once you run the scan, I always look at the results and then put them in a chart list and flip through them. The goal with your scanning engine, in my opinion, should be to get to a list of charts that you can visually start to identify. The scanning engine tells you what charts you should be looking at, and it's a great way to do it. Another way I use the scanning engine is just looking at particular sectors. If I want to look at the healthcare sector and start to dig in a little more detail, I'll use the Scooter reports and the industry summary page, but I'll also run a scan, which allows you to do some really cool things with chart lists and everything. So that's one that, that I would certainly look at as well. Just maybe one other quick one. This was a pullback scan. Let's see, pullback and long-term uptrend is one that might be worth looking at. So there's a lot of language. You can see that there's different ones that you can do, but remember that you can do changes in any of these. So all of the different indicators, including price, but other indicators are all based on timestamp. I mean, it's all data series, time series that you can incorporate. So this is one where I'm saying the 200-day moving average today is higher than it was 5 days ago. And then the fast stochastics is below 30, which basically means the long-term trend is positive because the 200-day moving average is sloping upwards, but in the short term, it's pulled back and the short-term stochastic are sort of oversold. So you can do things like that to actually combine things. So, in general, what I would tend to do if you're not sure what to do on a scan is bring up a chart that you use, see where a chart is that you would want to screen for, look at where different indicators are, and tell the scanning engine to look for that scenario. That can be a great way to get started. That was my quick 3-minute rundown of the scanning engine. I hope that was helpful. If you have trouble with it, just shoot a note to our support desk that can help you do some of those things. Next question, if you have to put a probability percentage of the market going up from here, breaking down from here, or going sideways between 3,200 and 3,400, what would those percentages be? And I love that question for so many reasons, but the main way is because I think you really got to the point of technical analysis. I think technical analysis deals in probabilities, never certainties. We love to think, okay, this is a buy, it is going up. And anytime you hear someone say it is going up, they're not 100% sure of that because we don't know what's going to happen. And there's a certainty that we want to have from technical analysis and from life that is just not realistic. And so what I've learned working with institutional investors for a number of years is that you treat technical analysis and most investment analysis as probabilistic. Here's the most probabilistic outcome based on the toolkit that I see. Then here are the other scenarios and here are the probabilities I would attribute to that. I think of it as a choose your own adventure and you have a couple different levers that you can pull. So your question was, what's my probability of we go above 3,400, we stay in this range, or we go down? You didn't really give me a time frame, so I'm going to guess maybe between here and year end, I guess. I'm not sure what you would what you think. That might be a little too long, but over the next month or so, yes, I would say there is a chance we just bounce around in these levels. I don't think that's incredibly realistic, so I'm probably going to put that pretty low at maybe 10%. The chance we break below 3,200, and I'm assuming you mean first, I think the chance we break below 3,200, I would say that's relatively high. I'd probably put that at 60%, and then that leaves 30% left for we break above 3,400. I think that's probably what I would say with that. I reserve the right to change that once I have a chance to think further about it, but that would be my initial thing. But what I just did is the way I would think about it. So for me, my base case is we break below 3,200. That's what I'm expecting. And that's what I'm sort of looking for. But you have to be aware and prepared for that not happening. That goes to what I usually call just emergency preparedness. I'm ready for the S&P to break above 3,400. As I've told you, I'm ready to tell you 3,600 is the next objective. And I'm ready to look for stocks that are going to push their way up to that point. Next question, have we made a higher low in the NASDAQ composite that would tell us the short-term trend has turned positive? And you actually sent a chart, which I really, really appreciate. There's this one. So this is the comp Q. This is your chart. So I haven't really looked at it. It looks like the last 6 months. And what you're indicating here, let's see, higher low 924. I think you're looking at this low versus that one, and then saying, is this a higher low here? You sent this to me. Yesterday. So here's the thing. I see where you're going with this, but what you want to do is when I talk about higher highs and higher lows, I kind of have something in mind, and a great way to illustrate this, we have this indicator called zigzag, which is not my favorite as like a trading system. So please don't think that I'm telling you this is all you need, but I think visually what it does is it shows you when I talk about higher highs and higher lows, this is kind of what I have in the back of my mind. This is an automated indicator that detects percent changes and puts this blue line in the background to illustrate where the highs and where the lows are going. I usually use the language swing highs and swing lows, and it's kind of with this in mind. The trend from March lows to where we topped out in September is pretty noisy. But if you look at this zigzag, which is just identifying the swing highs and swing lows, you can see the highs the highs, the peaks in this blue line are getting higher, the lows are getting higher as well. Higher highs, higher lows means an uptrend. When that changes, when we get lower lows and lower highs, which we've now seen, the short-term trend is downward. So first we need a higher low. I don't know if I would technically call this a higher low just yet, because I feel like we kind of hit the same level. I think that was just not yet a lower low, but so that we might disagree on. But the question is, did we make a higher swing high here? And I think, for me, I would really want to see a break above these highs, and that's sort of what the S&P chart would look like for me. So this sort of gives you a visual of what I mean when I'm saying higher highs and higher lows. So you can't at this point say that's a higher low. You need a pullback, and you need the pullback level to be above these previous lows. That's the key. So it's the swing high and the swing low that you want to see at higher or lower extremes. Really good chart, and thanks for sending that to me. Okay, last question, then we really have to run here. Your final episode is good. You're welcome. Thank you. I have a question on copper futures. It appears today there's a 5% sell-off. This was earlier this week. Checking if this is an indication of broader global growth weakness or a temporary correction. Can we establish any meaningful correlation between the indexes and copper? So I put this chart together on your question, and this is the copper chart that I tend to refer to. I don't bring it up very often, and the reason is because traditionally, you would look at copper as a measure of economic, growth, because when an economy is growing, you need lots of copper for stuff. And so especially with, China in a huge growth mode, you would see copper prices going up. That would tell you economies are growing. That's a good thing. If you see what's happened from March to now, less as the economy getting better, but more of a liquidity thing and the Fed supporting things, that's not really reflected in copper prices necessarily. And I think one of the ways you see that is if you look at the correlation between copper and the S&P 500, which is what we're showing at the bottom on a rolling 20-day basis. You can see that for some periods, it's actually been very positively, strongly correlated, and that makes sense. But there are a lot of times where it's sort of been a wash, and the last 6 months are arguably one of those periods. So I'm not looking for copper as a great signal necessarily, only because I don't see what's happened recently as a vote of confidence on the economy. I feel like it's a lot of other things. It's stimulus and it's other, expectations for the coronavirus, and it's less, are the economies actually able to grow? But if that's what you assume, copper is as good a place as any, I think you could see, besides other economic data, to really validate that growth story over the long term. The correlations are a really good way to try to make sense of that. That's all the time we have for the mailbag. We'll do it again next week, and hopefully continue with many good questions. Let's get to the 3 and 3 charts in about a minute. We're going to go. Chart number 1 is the gold ETF GLD, and I point this out when we talk about the S&P in a period of lower highs and lower lows, and seeing if that's able to rotate. Gold and silver certainly have been in a lower lows and lower highs environment. That's absolutely right. Key level we've focused in on, from my perspective, is around 172 to 172.50. And this is really taking some Fibonacci retracements on the GLD and lining it up with where I could see us bouncing. And so I think at this point, there's limited downside to that support level. We've bounced a little bit above there about a week ago. And I think if we do settle back down again, I think that's where you would expect some support. I think at that point, expecting further upside, if not already, is reasonable. If we would break through that, that would change my thesis for sure. Chart number 2 is looking at the relative strength of semiconductors, the SMH versus the SPY. This is something I've looked at for a while now. And, while the S&P is sort of still down here trying to figure out if it's breaking out or not, semiconductors have resolved to the upside, outperforming along with a lot of technology. Gave back a good amount of that today, but overall the trend remains pretty positive. So strength in semiconductors, I would argue, certainly speaks to underlying strength in the market, and for that data point remains fairly positive. Finally, in terms of breadth, I'm going to be looking at that once we lock in the closing data for today. But overall, I'm concerned about the weakening breadth outside of large caps and in mid caps and small caps. You'd want to see a break above the swing high from that second to third week in September. It's what we've not necessarily seen yet. Folks, that is a wrap for this week on The Final Bar. Appreciate you joining us every weekday after the close for our show. We have so many great guests on here. All of our previous episodes are on our YouTube channel, so check them out. As a reminder, we'll do another mailbag segment next week. Shoot us an email, thefinalbar@stockcharts.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.